Welcome to the debate. Usually when we investigate a huge disaster, like a building collapsing, we look for a massive event, like an earthquake or a hurricane. We want to find a really obvious immediate force that brought the whole thing down.
Right, yeah. It gives us a clear villain. I mean, it is just human nature to look for the spark right next to the explosion.
Exactly. But what if the collapse was actually, written into the blueprints nearly a decade earlier? What if the earthquake was really just a slight breeze, and the true cause of the destruction was just a tiny, innocent-looking math formula hidden deep in some rulebook?
Oh, wow, yeah, that changes the whole picture.
Right. So today, we are examining one of the most devastating financial events of the late 20th century. We are talking about the 1997 Asian financial crisis. And specifically, we are looking at who or what is truly to blame here.
And we are focusing on the historical analysis of how this all unfolded.
Yep. My position is that this crisis was fundamentally a structural failure. I believe it was engineered by international banking rules, specifically the 1988 Basel I Accord, and then made much worse by the harsh conditions forced on them by the International Monetary Fund.
And, well, while I agree that the global rules were definitely flawed, I will argue that the true root causes of the crisis were extreme local mismanagement. Really bad currency regimes and super dangerous levels of local borrowing. The global rules existed everywhere, sure, but the fatal choices were made locally, especially in places like South Korea, Thailand, and Indonesia.
Okay, so when we look at the 1997 crisis, the standard story usually points to things like weak Asian supervision and stubborn currency pegs. But beneath all of that sat a massive global trap. And it was set in Switzerland back in 1988.
Right, by the Basel Committee.
Exactly. The Basel I Accord was basically the global rulebook for banking, and it divided the world into two simple categories. You had OECD member countries, which is basically the club of wealthy developed nations, and non-OECD countries. And for a Western bank lending to a non-OECD bank, like those in Asia, the rules created this massive distortion.
You're referring to the 20% loophole.
Yes, exactly. If a Western bank gave a loan to a Korean or Thai bank, and that loan was for more than 1 year, it faced a strict 100% risk weight. But if that exact same loan to that exact same bank was for under 1 year, the risk weight dropped to just 20%.
Wait, let me stop you there to make sure I'm following the sheer mechanics of this, because it's important we don't gloss over the math here. When you say risk weight, you are basically talking about the regulatory penalty, right? Like the amount of safety money a bank has to hold in its vault just in case the loan goes bad.
Precisely. Let's make it super simple. Imagine a Western bank lending $100 to a Korean bank for a 10-year project. Under a 100% risk weight, the rules required the Western bank to hold $8 in safety reserves.
Okay, $8.
But if they lent that same $100 for just 364 days, the 20% risk weight meant they only had to hold $1.60 in reserve.
So mechanically, they can make 5 times as many loans using the exact same amount of safety buffer, just by artificially topping the timeline down to under a year.
Exactly. It is the same borrower, the same country, but 1/5 the cost for the bank. I mean, think about the madness of that from a risk perspective. A loan due in 364 days is somehow considered perfectly safe, but a loan due in 366 days is severely penalized.
Yeah, that makes no logical sense.
Right, it makes no sense. But for the banks, it was a 5-to-1 advantage. So money just flooded into emerging Asia, but almost entirely on dangerous short-term horizons. The whole region got hooked on 1-year funding. The crash was an inevitable result of a rule that practically forced everyone to rely on short-term cash.
That's a compelling argument, but have you considered how that money was actually deployed once it crossed the border? I mean, I hear the structural argument, and the math of that 5-to-1 advantage is undeniably absurd.
Extremely absurd.
But, a flawed global rule does not excuse extreme local recklessness. We have to look at what the Asian banks actually did with that cheap short-term money. So in South Korea, for example, the main pathway for these funds were these lightly regulated institutions known as merchant banking corporations, or jeonggeumsa.
Right. the newly liberalized banks.
Yeah. And these institutions engaged in a textbook, deeply dangerous financial maneuver. It is called maturity transformation.
Basically, borrowing short to lend long.
Yes, and I want to emphasize just how risky this is for our listeners. Borrowing short to lend long is like paying off your 30-year home mortgage using a credit card.
Oh, wow. Yeah.
And you have to completely pay off and renew that credit card every 30 days. It is super profitable in good times because short-term interest rates are usually much lower. So the Korean merchant banks borrowed US dollars at low rates from Western banks on one-year terms.
And then what did they do with it?
They converted those dollars into Korean won and lent them to massive domestic companies to build huge, slow projects. Things like steel mills and semiconductor plants.
Which take years, if not decades, to actually make money.
Exactly. You cannot just liquidate a half-built steel mill to pay back a one-year loan. You are entirely dependent on the Western bank agreeing to roll over the loan for another year. But the scale of this is what makes it a local failure.
How big was the scale?
Massive. By the end of 1996, Korea's short-term external debt was an astounding 285% of its foreign exchange reserves.
So almost 3 times what they actually had in the bank.
Right. Thailand's ratio was around 135%. Korea had built a position where its immediate debts were nearly 3 times the actual usable dollars it held in its central bank. Any sudden refusal by Western banks to renew those loans would trigger an instant collapse. The Basel rule made the debt cheaper, sure, but no international rule forces a country to operate with zero safety net. The rule existed everywhere, but the house of cards was built locally.
Okay, but those local hands were operating in a system where the rollover machine was functioning perfectly. It was driven by those exact rules, right up until an outside force pulled the plug. Let us look at the actual trigger for the crisis.
Okay, let's look at it.
Because the crisis did not start because Asian markets suddenly realized their own flaws. It started because of forces completely outside of their control. The largest single lender to emerging Asia in 1997 was Japan. Japanese banks held 42% of all foreign loans to emerging Asia.
That is a huge chunk.
Massive. And Japanese banks were bleeding from their own domestic crisis back home, which ironically was also triggered by these same Basel I rules earlier in the decade.
Right, the post-1990 stagnation in Japan, the bursting of their bubble.
Yes, it was grinding them down. So by 1997, Japanese regulators were applying intense pressure. When a huge Japanese bank failed in late 1997, it sent shockwaves through their whole system. When Thailand devalued its currency in July 1997, Japanese banks had to blink first.
They had to save themselves.
Exactly. They pulled their money out of Asia not because Asia suddenly got worse overnight, but because they desperately needed the cash at home. Then European and American banks saw Japan running for the exits and they panicked too. The rollover machine stopped dead.
It is like setting the speed limit at 100 miles per hour on a mountain road and then blaming the drivers when the actual road collapses underneath them.
I come at it from a different way. I wouldn't use the mountain road analogy because the road itself didn't collapse. It is less about a collapsing road and more like these local banks decided to build a massive skyscraper on a floodplain.
A floodplain?
Yeah. When the inevitable flood came, which was the Japanese withdrawal, the water didn't care about the global rules. It cared about who didn't build a sturdy foundation. That's an interesting point, though I would frame it differently, because the flood hit the entire region, yet some countries actually survived it fine.
That is a compelling argument, but have you considered Taiwan and Singapore? Because they are precisely my point. The exact same Basel rules apply to lending in Taiwan and Singapore as they did to Thailand and South Korea.
True, they were under the same system.
Yet, Taiwan and Singapore escaped the worst of the crisis. Why? Because the difference wasn't the Japanese withdrawal. The difference was that Thailand and Korea had built economies with pegged exchange rates and practically zero shock absorbers.
Meaning they promised to keep their currency price flat.
Right. A currency peg is basically a promise by a central bank to artificially manipulate the market. To keep that promise, they have to constantly burn through their own safety reserves. When you have short-term debt at 285% of your reserves, a creditor pulling out isn't a bump in the road. It's fatal. They drowned because they lacked basic economic common sense.
I see why you think that, but let me give you a different perspective on just how absurd these global rules actually were. Because if this was truly about markets rationally looking at the foundations of these countries, then random regulatory labels shouldn't have mattered. But they absolutely did.
What do you mean by labels?
Look at South Korea's membership in the OECD. South Korea joined the OECD in December 1996, just months before the crisis hit. Under the logic of the Basel framework, Korean banks should have instantly benefited from much better safety ratings simply because they joined a political club in Paris.
Right. They literally thought a country club membership changed the math of their debt. It's wild.
It is completely wild, but that's exactly how the global system operated. The reality on the ground was that Korea was the exact same country with the exact same debt on December 11th as it was on December 12th after joining. The fact that the entire global banking system was making decisions based on a crude label, OECD versus non-OECD, proves the rules were totally disconnected from actual reality.
Well,
The system wasn't rationally looking at the risk. It was exploiting a loophole. When the panic started, the market didn't care about the label because the whole framework was a fiction. The rules created a massive blind spot.
I'm sorry, but I just don't buy that. Let me tell you why. You are arguing that the rules were absurd. And on that specific point about the OECD, I absolutely agree with you. Using a political club as a proxy for safety is terrible design.
It really is.
But you are using that absurdity to excuse the very real, very tangible debt crisis that Korea built for itself. Joining the OECD in late 1996 didn't magically erase the fact that the underlying money was physically tied up in slow, multi-year projects.
Right. The steel mills.
Exactly. When the market panicked in 1997, it wasn't because of a regulatory label, and it wasn't because someone forgot to update a spreadsheet. The market panicked because the money was gone.
But the money was gone because the system was basically designed to flee at the first sign of trouble.
No, the money was gone because the Korean merchant banks had locked it up in 5-year loans for factories, while promising to pay Western banks back every 364 days. You can point to the silly rules all day, but the fundamental law of banking is gravity. You must be able to pay your bills when they are due. Korea, Thailand, and Indonesia consciously chose a model that relied on hot, fast money to fuel super aggressive growth. Blaming the rules takes away their agency as sovereign nations.
But agency implies a fair choice. When the cost of long-term money is heavily manipulated to be 5 times more expensive than short-term money, developing nations competing for growth don't really have a choice. But look, even if we blame local actors for building on the floodplain, we have to look at what happened when the ambulance arrived.
You mean the IMF?
Yes, because the IMF intervention is where the structural argument becomes undeniable. In my view, the IMF turned a severe cash problem into an absolute economic depression.
The IMF provided a $58.4 billion rescue package for Korea. I mean, it was an unprecedented, necessary lifeline.
A lifeline wrapped tightly around their necks. The IMF arrived with rescue money, sure, but it came with brutal pro-cyclical conditions.
Wait, let's explain what you mean by pro-cyclical for a second, because that's a heavily loaded term.
Fair point. Pro-cyclical basically means the rule forces you to act in a way that makes a bad situation exponentially worse. Chief among the IMF's demands was that bleeding Asian banks immediately achieve an 8% safety buffer.
Right, a strict capital ratio.
Think about the sheer madness of this. As Joseph Stiglitz pointed out, he was the chief economist of the World Bank at the time. Demanding immediate safety buffers during a blind panic is insanely pro-cyclical.
How do you increase your cash buffer during a panic?
Well, you can't really raise new money. No one is buying bank shares in a crash.
Exactly. You can't raise new cash. So mathematically, you have only one option. You have to shrink the other side of your balance sheet. In plain English, Asian banks had to frantically call in loans from perfectly healthy domestic companies. They had to refuse to renew loans for everyday businesses and force them into bankruptcy.
Which caused the credit crunch, a massive domestic credit crunch. In Korea, the economy shrank by 5.7% in 1998. Unemployment tripled practically overnight. The IMF treated a temporary cash flow problem like the whole country was bankrupt, And they literally forced the destruction of the domestic economy just to satisfy an arbitrary global math standard.
A temporary cash flow problem? I have to strongly disagree with that phrasing. These banks were fundamentally bankrupt. You were looking at the IMF intervention through the Stiglitz lens, which basically views the Asian economies as healthy victims of an irrational market.
Because they largely were.
But if we look at the Stanley Fischer perspective, he was the first deputy managing director of the IMF at the time, we see a much more realistic picture of the rot inside the system. Sick, failing banks were the core disease causing the crisis.
I'm not convinced by that, because forcing banks to sell off everything in a fire sale doesn't cure the disease. It just kills the patient faster.
But what was the alternative? Would allowing bankrupt merchant banks to continue operating without strict safety limits have truly restored global market confidence? The answer is clearly no. If the IMF had simply handed over $58 billion without demanding strict reforms, the capital flight would have just continued forever.
So you're saying the harsh rules were the only way to build trust?
Exactly. Western and Japanese lenders would have simply used the IMF money to exit even faster, leaving the Korean taxpayer holding the bag. The medicine was incredibly harsh. Yes, I do not deny that. The crash in 1998 was brutal. But Korea actually repaid its IMF loan by August 2001.
3 years ahead of schedule, yeah.
Right. Which suggests that clearing out the deadwood and forcing banks to be responsible was the only way to save the system. The IMF didn't create the bankruptcies, it just forced everyone to finally admit the losses that had already happened.
But it forced them to recognize losses in a way that caused maximum pain at home while protecting international lenders. The whole sequence, from the 20% loophole that pumped the cheap dollars in to the rigid IMF rules that forced the fire sales, it shows a global system that was fundamentally biased. The global architecture was not merely the environment here, it was the primary catalyst.
Look, I understand the desire to blame the global architecture. It feels really unfair that Western banks were incentivized to pump hot money into these economies and were mostly bailed out later. But we must return to the simple reality of the data.
Which data point?
A rule making short-term lending cheap does not force a nation to hold debt equal to 285% of its reserves. That requires profound local complicity. It requires regulators to turn a blind eye. And it requires a central bank to stubbornly defend a bad currency peg until the vault is entirely empty. The rules offer cheap debt, sure, but the decision to gorge on it without a safety net was made entirely at home.
So to quickly summarize our positions as we wrap up today, I think where we do find a powerful area of agreement is acknowledging that the Basel I framework was, at the very least, the blueprint that determined the shape of the crisis. We may disagree on the ultimate blame, whether it's mostly the fault of structural traps or mostly the fault of domestic recklessness.
Right.
But we both recognize that the 20% loophole created a massive, uniform distortion across the whole region. The speed of the collapse was undeniably amplified by the global rulebook.
I completely agree with that summary. The structure determined how the water flowed into the basin, so to speak. And to your earlier point about the absurdity of the OECD rule, the fact that the rule stayed in place until 2004 tells us a lot about the terrifying delay between financial innovation and actual regulation. Capital moves at the speed of light, while regulation moves at the speed of a glacier. That is something that should deeply concern us today.
Absolutely. And that leaves us with a profound lesson. Complex systems often find completely unexpected ways to fail. The regulators who wrote Basel I weren't evil. They were trying to solve the problems of their specific era. They succeeded in one area, only to accidentally build a mathematical time bomb that blew up Southeast Asia a decade later.
Yeah, it really makes you wonder what the modern equivalents are today.
Exactly. With shadow banking and complex global markets, what innocent-looking rule today is quietly engineering the next crisis?
It is a critical question. And it shows why anyone trying to understand global finance has to look at both the big picture architecture and the local micro-level decisions. You have to understand both the global system and the local institutions. I highly suggest that our listeners explore the primary source materials further to form their own conclusions, specifically the competing analysis from Stiglitz and Fisher.
Indeed. Because as we've seen today, when a building collapses, you can't just look for the earthquake. Sometimes the destruction was drawn right into the blueprints long before the first brick was even laid. Thank you for joining us,